we are going to look at the maintenance of the capital account. Each partner is going to contribute some amount as its capital. There are two methods of maintaining the capital account. One is the fixed capital account method, and second is the fluctuating. Now let us look at these two methods in detail. Now what does fixed capital account means? So in a capital account, the following types of transaction can take place. Introduction of capital, withdrawal of capital, profit or loss of the partner, interest on capital if any, interest on drawings, salary, etc. So capital is basically all the transactions other than loan that has been done with the partners and all the entitlements of the partner. So what does fixed capital account consider? Fixed capital account says that suppose Ram has brought in a capital of 1 lakh rupees. Of 1 lakh rupees. Now, he was entitled to a profit for the year of say 10,000, and interest on capital of say 1,000 rupees, and a salary of 12,000 for the year 2019 to 2020. Now the fixed capital account method says that the capital contribution of Ram is fixed, that is 1 lakh rupees. All the other transactions, that is a profit, interest on capital, and salary, are the day-to-day transaction with the partner. That is, these elements should not alter the total capital contribution that Ram has provided. Until and unless Ram decides to withdraw any portion of this 1 lakh rupees, this should remain fixed. All the other transactions with Ram should be recorded in a separate account, that is, the current account. So, in fixed capital account method, two separate accounts are maintained. That is capital account and current account. So in this example, at the end of 31st March 2020, the capital account will reflect a balance of 1 lakh rupees credit, and current account will reflect a balance of 23,000 credit. That is 10,000, 1,000, and 12,000. In fluctuating capital account, for each partner, only one account is maintained. Each partner only has one account, that is the capital account. Therefore, all these transactions of Ram will be recorded in a single account, and so the capital account will reflect a balance of 1,23,000 in case of a fluctuating capital account method. Now the second difference is also based on this. In fixed capital account method, all adjustments for drawings, salary, interest on capital, etc. are made in the current account, whereas in fluctuating capital method, all adjustments are made in capital account. Then next, in the fixed capital method, as we can see, the capital account does not change year on year because all the yearly transactions such as profit, interest on capital, etc. are routed through the current account. So the capital account balance remains unchanged unless there is an addition to or withdrawal of capital. But in case of fluctuating capital account, the balance of the capital account fluctuates from year to year because we account for the profit, interest on capital, etc. in the capital account itself. Now the fourth and the last difference is the capital account will always show a credit balance. Now this is because Ram is having a capital of 1 lakh rupees. He obviously cannot withdraw more than this amount. So the balance will always be a credit balance. But in case of fluctuating account, say the capital contribution is 10,000 rupees. The firm had incurred a loss in the current year of 20,000 rupees. So, under fixed capital method, capital account will show a credit balance of 10,000 rupees and current account will show a debit balance of 20,000 rupees. But in case of fluctuating method, since both these transactions will be routed through the capital account itself, so it will show a balance of 10,000 rupees debit at the year end. Therefore, fixed capital account will always reflect a credit balance, whereas in fluctuating method, the capital account may reflect a debit or a credit balance. Now let us try to understand this concept better with the help of an example. So let us begin with this question. In this question, we have to prepare the capital account under fixed capital method and fluctuating capital method. In the fixed capital method, we have to prepare the capital account and the current account of each of the partners. So let us start with the question. Ram and Rahim started business with a capital of rupees 50,000 and 30,000 on 1st Jan 2019. So on 1st Jan 2019, the capital contribution of Ram will be accounted for by bank account 50,000 in case of Ram and 1st Jan 2019 by bank account 30,000 in case of Rahim. Next we have Rahim is entitled to a salary of 400 rupees per month. Now since this is the fixed capital account method, we are going to account for this transaction in Rahim's current account. Therefore, 31st December 2019, by PL appropriation account, salaries 400 into 12, that is 4800 credit in Rahim's current account. Next we have interest is allowed on capital and charged on drawings at the rate of 6% per annum. Now in this question, since interest on capital and drawing is specifically mentioned as 6%, we are going to provide for them. Had the question been silent, we would not have provided any interest. So, interest on capital for Rahim, the capital was 30,000 rupees into 6%, giving us 1800 rupees. For Ram, by PL appropriation account, interest on capital was 50,000 rupees into 6%, giving us 3,000 rupees. Now it is given that profits are to be distributed equally. During the year, Ram withdrew 8,000 and Rahim withdrew 10,000. So in Ram's account, to bank account for drawings is 8,000. Rahim's account to bank account 10,000. Now we will have to charge an interest on this account, on these balances. So to PL appropriation account, in case of Ram, interest on drawings will be, the drawings was 8,000 rupees into 6% per annum. Now since the date of drawing is not mentioned in the question, we'll assume that it was made in the middle of year and therefore the interest will be charged for only 6 months. Therefore the interest amount will be 8,000 into 6% divided by 2, giving us 240 for Ram, and for Rahim it will be 10,000 rupees into 6% into 6 by 12, giving us 300 rupees. The next adjustment is given that profit for the year after all adjustment is rupees 20,914. So profit for the year will be 20,940. Now the profit sharing ratio is given as 1:1. So 10,470 for Ram and 10,470 for Rahim. So now that we have treated all the adjustments that have been given in the question, let us balance the account. So Ram's capital account, there has been no withdrawal or addition to the capital. So on 31st December, to balance carried down is 50,000 rupees. Similarly, in case of Rahim, to balance carried down for capital account will be 30,000 because there was no addition or withdrawal of capital. In case of current account, to balance carried down will be 13,470, giving us 5230. balance carried down for Ram, and for Rahim it will be 4800 plus 1800 plus 10470, giving us 17070 minus 10,000 minus 300, giving us 6,770 for Rahim. So we have prepared all the accounts under fixed capital method. Now let us look at the fluctuating capital method. In fluctuating capital method, only one account will be prepared, that is Ram's capital account and Rahim's capital account. But all the calculations will remain the same, only all the postings that we had done in the current account will now be done in the capital account itself. So on 1st Jan 2019, Ram had brought in a capital of 50,000 rupees. So by bank account 50,000. Similarly, for Rahim, he had brought in a capital of 30,000 rupees. Now Rahim is entitled to a salary of 400 per month. So P&L appropriation account debit to Rahim's capital account. Salary is 4,800 rupees. Next we have interest is allowed on the capital at 6% per annum. So in case of Rahim, the capital brought in was 30,000 rupees. So interest will be provided at 30,000 into 6%, that is 1,800. For Ram, by PL appropriation account, interest on capital 50,000 into 6%, giving us 3,000 rupees. Next we have Ram withdrew 8,000 rupees. So to bank account for drawings is 8,000 for Ram and 10,000 for Rahim. Similarly, to PL appropriation account, interest on drawings we'll be taking as for only 6 months, because we have not been given the exact date of drawing. Therefore, the interest on drawings will be 8,000 into 6% into 6 by 12, 240 for Ram and 10,000 into 6% into 6 by 12, that is 300 for Rahim. Now the profit for the year is given as 20,940. The profit sharing ratio is 1:1. So we'll divide the profit equally between both the partners as 10470 for Ram and 10470 for Rahim. Now we are going to balance these two accounts. So it is 63,470 is the total. It is 55,230 for Ram and for Rahim it will be 30,000 47070 minus 10,000 minus 300, so 36770. So we'll see if we add the balance carried down in Ram's capital account and Ram's current account under the fixed capital account method, we'll be getting the total balance carried down under the fluctuating capital method. So with this, we have finished with this sum. In case you have any doubts with respect to the concepts that we had covered in this video, you can post them in the comment section below. If you like the video, do share and subscribe. Thank you.